Gold just hit $5,500 per ounce. Let me say that again, $5,500 per ounce. If you think that sounds insane, you are absolutely right, because less than 2 years ago, gold was trading around $2,000. That is a 175% increase in just 24 months. But here is what really has everyone talking. Gold has been moving so fast that some days it jumps $50, $100, even $200 in a single trading session. The kind of volatility we usually see in cryptocurrency is now happening in the oldest safe haven asset known to humanity. So what is going on? Why is gold absolutely exploding right now? And more importantly, what does this mean for your money, your savings, and your future? Those are the questions we are going to answer in detail today. By the end of this video, you will understand exactly why gold is surging, what the experts are predicting, and whether you should be paying attention to this historic rally. Whether you own gold or not, this matters to you, because when gold moves like this, it is telling us something critical about the state of our economy, our currency, and the financial system itself. Let me be clear from the start. I am not here to sell you gold. I am not a gold dealer. What I am is someone who follows markets closely and wants to help you understand what is really happening behind the headlines. Because mainstream media is not giving you the full picture. They will show you the price chart, sure, but they will not connect the dots for you. Today, we are connecting all the dots, so stay with me because this is going to be eye-opening. Let me give you the numbers first, because they are truly staggering. As of January 28, 2026, gold reached $5,419.64 per troy ounce. Just one day later, it pushed past $5,500. To put this in perspective, gold has gained over 25% since the beginning of 2025 alone. That is just 13 months. 25% gains in a year for any asset is impressive. But for gold, for an asset that people traditionally view as stable and slow-moving, this is extraordinary. Here's what makes this even more remarkable. Gold does not pay dividends. It does not generate cash flow. It just sits there. Yet it is outperforming most stock indices, real estate markets, and bond portfolios. That should tell you something important is happening. The rally has not been smooth either. We have seen days where gold jumps $75 to $100 in a single session. Then there are the really wild days, where moves of $150 to $200 happen. These are not normal market conditions. This is panic buying mixed with institutional repositioning on a massive scale. Goldman Sachs, one of the most respected investment banks in the world, recently updated their forecast. They now predict gold will reach $5,400 per ounce by December 2026. But here's the kicker. They made that prediction when gold was already trading near that level, which means they think gold is going to stay elevated or go even higher. Other analysts are even more bullish. Some forecasts put gold between $6,000 and $7,000 per ounce within the next 18 months. A few extreme bulls, like Robert Kiyosaki, are predicting even more dramatic moves. Kiyosaki recently said he expects silver to hit $200 per ounce, which would imply gold could reach $10,000 or more. Now, are those predictions guaranteed? Absolutely not. Markets do not move in straight lines. But the fact that serious institutions are making these calls tells you the fundamentals have changed dramatically. Something shifted in the global financial system, and gold is reflecting that shift. So what is driving this incredible rally? The answer is not simple because multiple powerful forces are converging at the same time. Let me break them down for you one by one. First, there is the safe haven panic narrative. When people get scared about the economy, about inflation, about currency stability, they buy gold. It has been that way for thousands of years. Gold is the ultimate insurance policy against financial chaos. And right now, people are freaked out. That is not my opinion. That is what the data shows. Reddit threads are filled with comments like this one from the middle-class finance community. People buy gold when they are freaked out. It is a hedge against uncertainty. It is not a good sign. The uncertainty is coming from multiple directions. Geopolitical tensions are at levels we have not seen in decades. Flashpoints in the Middle East, concerns over Greenland, situations in Venezuela. HSBC specifically cited geoeconomic issues related to Greenland as one factor pushing gold higher. These are not typical market concerns. Second, there is the Federal Reserve crisis. Gold surged to an all-time high when news broke about a criminal investigation into Federal Reserve Chair Jerome Powell. Whether that investigation leads anywhere or not is beside the point. The mere fact that the independence and credibility of the Federal Reserve is being questioned sends shockwaves through financial markets. The Federal Reserve controls the money supply of the world's reserve currency. If confidence in the Fed wavers, confidence in the dollar wavers. And when confidence in the dollar drops, gold rises. It is that simple. Third, we have the massive central bank buying that started in 2022 and has not stopped. Before 2022, central banks around the world were buying an average of 17 tons of gold per month. That was the norm for years. Now, Goldman Sachs estimates central banks are purchasing around 60 tons per month. That is more than triple the historical average. Why are central banks buying so much gold? Because they are diversifying away from the United States dollar. Countries like China, Russia, India, and Turkey have been accumulating gold at unprecedented rates. They are building reserves that protect them from dollar volatility and give them more financial independence. This institutional demand creates a floor under gold prices. It also signals that major global players expect currency turbulence ahead. Central banks have access to information and analysis that retail investors do not. When they move in unison like this, we should pay attention. Fourth, there is the inflation and currency debasement story. Yes, official inflation numbers have come down from their peaks. But let me ask you this. Do your groceries feel cheaper? Does your rent feel cheaper? Does healthcare, education, or insurance feel more affordable? For most people, the answer is no. Real inflation, the kind you experience in your daily life, remains elevated. And everyone knows that governments around the world have been printing money at historic rates since the COVID-19 pandemic. More dollars chasing the same amount of goods means each dollar is worth less. Gold does not lose value because of money printing. That is why it is called a store of value. Now let me share something that might make you uncomfortable. Economist Peter Schiff, who is known for being pessimistic but also for being right about the 2008 financial crisis, recently made a stark comparison. He said, "Gold's surge in 2025 likely portends a United States dollar and sovereign debt crisis next year that will make the 2008 financial crisis look like a Sunday school picnic." Those are strong words. A Sunday school picnic. That means he thinks what is coming will be much worse than the worst financial crisis most of us have lived through. Is he right? I do not know. Nobody knows the future with certainty. But here is what we do know. The United States national debt is now over $36 trillion. That number is so big, it is almost meaningless to our brains. Let me put it this way. If you spent $1 million every single day, it would take you 98,630 years to spend $36 trillion. That is how much debt we have accumulated. Interest payments on that debt are now over $1 trillion per year. Here is the problem. To service that debt, the government has two options. Option 1, raise taxes dramatically and cut spending dramatically. Option 2, print more money and inflate the debt away. Which option do you think is more politically palatable? Which option do you think they will choose? If they choose option 2, which history suggests they will, then the value of the dollar will continue to decline, and gold will continue to rise. This is not a conspiracy theory. This is basic economics. Schiff's comparison to 2008 might sound extreme, but remember, in 2008, gold was around $800 per ounce. By 2011, it had risen to over $1,900. Let me talk about what this means for investors, because this is where things get really interesting. There are several ways to gain exposure to gold, and each has different risk and return profiles. First, you can buy physical gold, coins, bars, bullion. This is the most direct way to own gold. You hold it, you store it, you control it. The advantage is that you actually possess the asset. Nobody can click a button and make your gold disappear. The disadvantage is storage, security, and the fact that physical gold does not generate income. Second, you can buy gold exchange-traded funds, or ETFs. These are funds that hold physical gold and issue shares that trade on stock exchanges. The advantage is liquidity and convenience. You can buy and sell with a click. The disadvantage is that you do not actually own the physical metal. You own shares in a fund that owns the metal. There is counterparty risk there. Here is something interesting about gold ETFs. There is growing discussion that they could reach new highs as pension funds and 401(k) plans start allocating more to gold after seeing these record prices. Think about that. Millions of retirement accounts shifting even a small percentage into gold could drive massive new demand. Third, and this is where things get explosive, you can invest in gold mining stocks. Here is the theory. When gold prices rise, mining companies do not just benefit a little, they benefit a lot. because their costs to extract gold are relatively fixed, but the price they sell it for keeps going up. That expanding profit margin can lead to dramatic stock price gains. Some analysts are suggesting that certain gold mining stocks could see gains of 300 times or more in 2026 based on physical shortage dynamics. 300x. That means a $10,000 investment could theoretically turn into $3 million. Now, let me be very clear. That is an extremely aggressive prediction. But even if the actual return is 10x or 20x, that would still be extraordinary. The point is that mining stocks offer leverage to the gold price. They amplify the moves, both up and down. If gold continues rising, mining stocks could significantly outperform the metal itself. But if gold crashes, mining stocks will crash harder. Not everyone is buying into the gold hype, and I think it is important to hear the other side. There are smart people who think gold is overvalued and due for a correction. Let me share some of their arguments. One Reddit user made this point. Zoom out and look at inflation-adjusted real compound annual growth rate over longer rolling periods compared to stocks. The argument here is that over very long time horizons, stocks have outperformed gold when you adjust for inflation. The S&P 500 has delivered higher returns than gold over most 30-year periods. That is a fair point. If you are a long-term buy-and-hold investor, stocks have historically been the better bet. But here is the counter-argument. Those historical returns assume you can handle the volatility. They assume you will not panic sell during crashes, and they assume the future will look like the past. Another skeptic wrote, "People been saying this for decades. They have been wrong. Do not buy into the hype and fear-mongering." There is also the taxation issue. One investor noted, you get to pay taxes on a 15% gain when the real value increased 5%, so you pay 5% in taxes and end up with no gain after inflation. After taxes, you might actually lose purchasing power even though the nominal price went up. Gold is not a tax-advantaged investment like a retirement account might be. So after hearing all this, what should you actually do? Should you buy gold right now? Should you avoid it? Let me give you my honest thoughts. First, I am not a financial advisor. I cannot tell you what to do with your specific situation. What I can do is share some principles that might help you think through this. Principle number 1, do not invest in anything you do not understand. If you do not understand why gold is moving, you are not investing. You are gambling. Principle number 2, diversification is your friend. Putting all your eggs in one basket is almost never a good idea. Some allocation to gold might make sense, but betting everything is speculation. Principle number 3, think about your time horizon. Gold can be volatile in the short term. Principle number 4, consider your risk tolerance. Can you sleep at night if your investment drops 30%? Principle number 5, dollar cost average if you are uncertain. Instead of putting all your money in at once, spread purchases over several months. Here is my personal view. I think having some exposure to gold makes sense in the current environment. Not because I am certain gold is going to double, but because the risks to the dollar and to the financial system are real and growing. Gold is insurance. You buy insurance not because you are sure your house will burn down, but because the cost of being wrong is too high. Let me zoom out for a moment and talk about what all this really means. Because the gold story is not just about one commodity. It is about trust. It is about confidence. It is about the future of money itself. For the past 80 years, the United States dollar has been the world's reserve currency, but that system is showing cracks. When central banks are buying 60 tons of gold per month instead of 17, they are voting with their wallets. They are saying, we do not trust this system to continue unchanged. We need a backup plan. When gold hits $5,500 per ounce, it is a signal that faith in fiat currency is weakening. It is a warning sign. Does that mean the dollar is about to collapse? No. But it does mean change is coming. The world is slowly moving toward a more multipolar financial system, a system where the dollar is still important but not dominant, a system where gold plays a bigger role as neutral money that no government controls. This transition will not happen overnight. It could take years. Let me bring this all together for you. Gold has surged to $5,500 per ounce. This is not normal. This is historic. The rally is driven by safe haven demand, central bank buying, Federal Reserve concerns, and fears about debt. Experts are divided and nobody knows for certain what happens next. But gold is a thermometer measuring the fever of economic anxiety. My challenge to you is this. Do not just watch the price chart. Understand what it means. Do your own research. Make informed decisions. Because in times of great change, the prepared prosper and the unprepared suffer. Gold has been money for 5,000 years. Empires have risen and fallen, currencies have come and gone, and through it all, gold has endured. Maybe that is worth remembering as we navigate the uncertain waters ahead. Thank you for watching. If you found this valuable, please like this video and subscribe to the channel. I will be tracking this story closely and bringing you updates as things develop. Stay informed, stay prepared, and I will see you in the next video.